On Thursday, September 18th, 1873, Wall Street did not collapse in a single visible instant. It jammed inside counters, ledgers, rail bonds, messenger routes, and private banking rooms where men spoke softly because the walls had become part of the market. The street outside still carried horses, carts, umbrellas, and clerks. The machinery inside had already shifted. By late morning, the district had started converting rumor into pressure. Bank doors absorbed bodies. Brokerage offices filled with customers asking for prices that had stopped behaving like prices. Clerks moved faster. Partners stopped explaining. Messengers crossed streets with sealed envelopes held flat against their coats. The newspapers later called it panic. That word helped the survivors. Panic suggests spontaneous motion. It suggests a crowd breaking discipline. It suggests fear as the cause, when fear may only have been the visible smoke. In the lower financial district, the useful question was colder. Who had warning before the public saw danger? Who had cash before collateral froze? Who had enough institutional protection to turn the crash into acquisition? The tickers recorded disorder. The wires recorded sequence. At the center of the official account stood Jay Cooke Company, the Philadelphia banking house that had helped finance the Union war effort, then tied its body to the Northern Pacific Railway. Cooke had sold bonds, carried bonds, promoted bonds, and absorbed bonds until railroad expansion and private solvency became difficult to separate. The Northern Pacific was more than a railroad. It was a promise stretched across land, legislation, speculation, and future settlement. The line required continuous capital long before it could return stable revenue. Its bonds had to sell before the rails could justify the bonds. That structure worked while confidence moved freely. By September 1873, confidence had become a rationed substance. Cooke's failure reached New York as fact, then weapon, then excuse. Once the firm closed, every exposed railway account in Manhattan could be marked suspect. Every loan secured by rail securities could be reviewed. Every ambitious family with leverage hidden beneath polished furniture could be reclassified. The exchange locked its doors 2 days later on September 20th and remained closed for 10 days. The calendar gave the appearance of reaction. The alleged private record gave another pattern. According to the 1894 deathbed confession of a former Western Union clerk, the decisive sorting began before the public closure. That confession is the document at the center of this file. It was said to have been opened in December 1894, inside a private legal office near Nassau Street, 21 years after the crash. The dying clerk had worked the Wall Street commercial circuits during the week Cooke failed. His hand could no longer hold a pen. A notary wrote while he spoke. The packet contained copied code fragments, routing notes, and one accusation. The crash had a public trigger. The purge had a private signal. According to the clerk, several hours before the panic became visible, an encrypted telegraph instruction passed through a privileged commercial relay. The message did not announce collapse. It directed movement. It identified which credit lines to call, which railroad securities to release, which reserves to protect, and which rising families should be left outside the shelter of old capital. A panic ruins whoever cannot move. A purge selects who remains unable to move. That distinction is the whole case. On the street, investors saw confusion. Inside the telegraph room, clerks saw priority. Certain messages moved faster. Certain names received handling that routine merchants never received. Certain financial houses appeared to know the shape of the crisis before the crisis had printed itself in public. The official history gives us Cooke's insolvency, railroad overreach, and the larger contraction of post-war credit. Those forces were real. They created the dry material. The intercepted wire theory asks who controlled the spark, who stood near the exits, and who owned the wagons waiting beside the ashes. History describes the Panic of 1873 as an economic event. This file treats it as an information event. The city did not die that week. It reorganized. Its doors stayed upright. Its banks continued to breathe through selected channels. Its oldest families discovered that locked markets could still transfer wealth, provided the transfer occurred in rooms without public quotes. The visible market stopped. The hidden market kept working. In 1873, information did not float through Wall Street as rumor alone. It struck metal, crossed copper, entered magnets, and returned as sound. Every major financial warning arrived through a machine before it became language. The Telegraph did not simply report the market. It measured who could act before the market became public. Inside the Western Union commercial room, the first sign of pressure was auditory. The sounders snapped against their stops in short bursts, then longer runs, then packed commercial sequences moving at roughly 25 to 40 words per minute. A trained operator heard pace, origin, urgency, and money. A slow wire carried ordinary business. A faster wire carried pressure. A broken rhythm meant correction, relay delay, or line congestion. A sudden burst from a known banking circuit meant the desk had entered a higher state of attention. The room changed before the street changed. The clerks knew it from sound. The machines made finance physical. Current moved through line coils and pulled small iron armatures down against the sounder frame. When the circuit opened, the armature returned. Click, time to me. Clack, dot, just a reminder, fine, dash, pause. The sounder converted distant intention into audible metal. Every message arrived with operational marks attached to it. The sender mattered. The route mattered. The hour mattered. The delivery class mattered. A message from a dry goods merchant crossed the room with one kind of weight. A message from a private banking office crossed with another. The envelope could look identical. The room heard the difference. Western Union's financial desk therefore worked like a pressure gauge beneath Manhattan. Operators copied messages onto blanks, checked routing marks, handed forms to delivery boys, and watched supervisors step closer when a known account transmitted outside its ordinary pattern. A clerk needed no full conspiracy. He needed only abnormal traffic. That recognition was mechanical. A line carrying routine price quotations produced a steady commercial rhythm. A line carrying emergency liquidation instructions produced compression. More cipher groups arrived in fewer minutes. Repeat requests followed. Priority delivery marks appeared. The paper stack rose before the public ticker admitted damage. The telegraph room also created a hierarchy of delay. A common merchant waited behind the queue. A privileged house moved through it. An ordinary message became paper. A protected message became motion. That difference required training, habit, and fear. The operator sat at the weakest point in the whole system. He earned wages, carried responsibility, and possessed temporary access to information worth entire estates. He copied words that could move rail securities, call loans, freeze collateral, and direct gold reserves before newspapers could set type. His poverty made him safe. His invisibility made him useful. This is the part modern viewers usually miss. Wall Street could begin collapsing before any public announcement appeared. It needed a sequence of private signals handled by men paid to pass meaning without owning it. The visible market reacted later. The wired market had already begun. By mid-morning on September 18th, the clerk in the 1894 confession claimed the sounders had changed character. They behaved like instruments under load. Cipher groups arrived with clipped spacing. Delivery boys were held near the desk. Supervisors checked copies before the ink dried. Several messages moved through financial routing faster than common traffic, although the street outside still believed the day remained open. The room did not shout. It counted. The sound of the crash began as disciplined metal striking wood at 30 words per minute. The deathbed confession identified the central message as arriving before noon on September 18th. The clerk gave the time as 10:42 in the morning. He described the circuit as a private commercial route carrying traffic between Lower Manhattan and Philadelphia, with relay handling through a Western Union desk reserved for financial business. He added one detail that gives the alleged record its forensic weight: the message strip jammed during transcription, forcing the operator to copy the cipher groups by hand before delivery. A machine error preserved the weapon. The message contained no plain confession. Capital rarely writes crime in moral language. It writes instructions. It writes timing. It writes categories that only authorized readers can convert into action. The clerk remembered fragments from the copied strip. Call at opening. Release Northern. Protect prime names. Decline renewals. Hold gold. Delay assurance. The phrasing was clipped, commercial, and cold. It sounded like routine handling because the violence had been translated into procedure. Those were operational commands. According to the confession, several cipher groups matched phrases used in previous high-value traffic connected to real estate trusts, railroad pools, and old family banking agents. The clerk never claimed that an Astor, Vanderbilt, or Morgan sat at the key. The system was cleaner than personal handwriting. Great fortunes used intermediaries. Intermediaries used offices. Offices used wires. Wires used clerks. By the time responsibility reached Copper, fingerprints had already been removed. The intercepted message performed 3 functions. First, it ordered protected accounts to reduce vulnerable rail exposure before the public understood Cooke's condition. Second, it instructed lenders to refuse selected extensions to new money houses whose collateral depended on railroad prices. Third, it directed trusted agents to preserve cash and gold for acquisition during the silence that followed. This was a liquidation map. The clerk called it the Manhattan Table, a phrase, he said, operators used privately for priority names during financial stress. Some names appeared as initials. Others appeared as office numbers, property references, or account tags. The protected side contained inherited land wealth, banking trustees, railroad insiders, and families whose credit could survive temporary darkness. The exposed side contained recent arrivals. They had railroad paper. They had borrowed status. They had townhouses above their fathers' stations. They had daughters entering drawing rooms where old families smiled without opening the inner door. They had leverage disguised as a rival. The purge found them quickly. At 11 o'clock, loan calls began moving through brokerage offices. By 11:20, certain renewals failed. At 11:45, a rumor became a pattern. At noon, the distinction between rumor and fact had lost practical meaning because liquidity had already been removed from the weakest public names. Jay Cooke's failure supplied the explanation. The private wire supplied the timing. Timing is the crime in financial history. A warning received early can be converted into safety. A warning received late becomes blame. The old families could later describe themselves as prudent, because they had acted before prudence became impossible for everyone else. The confession claimed that one operator, identified in the packet only as R. Mallory, copied a second version of the cipher groups into a waste ledger after noticing a routing irregularity. Mallory died in 1879 after a fall near a ferry slip. The police report called it an accident. The confession treated it as file closure. No surviving public archive confirms the waste ledger. That absence matters less than the pattern inside the allegation. The code groups named categories of action rather than names of guilt. Acre paper referred to real estate-backed obligations. Western Rail Second referred to subordinate railroad bonds. House C appeared near Cooke-linked exposure. Green Reserve referred to available cash or gold equivalent settlement. The phrase guest line appeared near the end. That phrase is the social key. Finance did not merely erase bank accounts in 1873. It erased access. It erased marriage prospects. It erased names from guest books, charity boards, pew assignments, and trustee rosters. A family could lose money and recover if old Manhattan treated the loss as misfortune. A family marked as reckless lost more than capital. It lost protection. The intercepted wire converted market crisis into social sorting. It allowed old capital to exit early, then judge the trapped survivors as irresponsible. It allowed the same men who withdrew liquidity to describe the victims as overextended. It allowed inherited wealth to wear the costume of discipline after private information had manufactured safety. That is the mechanism. Power moves first. Then it names the outcome natural. The clerk said he remained silent because silence was the profession. Operators were bonded, supervised, underpaid, and replaceable. They saw enough to understand danger while owning too little to survive disclosure. A man without a bank, newspaper, family office, or club membership could know the structure of the crime and still possess no usable power. So he waited. He waited through Reconstruction. He waited through New Depressions. He waited through funerals, marriages, rebuilt fortunes, and sanitized biographies. He waited until 1894, when his body failed before his memory did. Then he dictated the message from proximity. He had not caused the crash. He had watched the switch get pulled. The official history gives Jay Cooke a simple function. He becomes the trigger. He becomes the failed banker. He becomes the man whose railroad gamble broke confidence. That version contains truth, which makes it useful. It also contains a gap large enough to hide the allocation of damage. Between 1866 and 1873, the United States laid roughly 35,000 miles of new railroad track, and the railroad industry became the nation's largest non-agricultural employer. Banks, insurers, manufacturers, and private investors pushed capital into rail expansion because railroads looked like infrastructure, progress, and collateral at the same time. In that climate, the Northern Pacific Railway operated as a balance sheet magnet dot. Jay Cooke's firm became the financial agent for that magnet. Northern Pacific bonds promised national scale, Western land value, and future traffic revenue. The trouble sat inside the timing. The railroad needed continuous funding before the route could produce stable returns. The paper had to sell before the line could prove itself. Confidence was the fuel. Debt was the engine. By September 1873, that engine had overheated. Cooke's underwriting exposure, rail-linked obligations, and an unsold bond load pushed the pressure into the tens of millions. For this case file, the operational threshold is over $30 million in rail-linked exposure and obligations, a number large enough to turn one firm's weakness into a national credit event. Cooke did not simply lose a speculative wager. He carried an infrastructure machine with no immediate cash outlet. The credit mobilia scandal had already damaged public trust in railroad finance. European capital had tightened after the 1873 financial shock in Vienna and the contraction of continental investment appetite. American rail securities lost their clean aura. Bond buyers became slower. Creditors became colder. Cooke needed time, and time had become the most expensive commodity in Manhattan. This is where the cartel theory enters. It does not need to claim Jay Cooke was healthy. The sharper claim is narrower. Cooke was exposed, and a coordinated withdrawal of liquidity made exposure terminal. A bank can survive weak assets while creditors extend time. A bank can die with valuable assets when creditors demand cash by noon. That distinction is the wound. The textbooks emphasize insolvency. The confession emphasizes timing. Insolvency explains why Cooke was vulnerable. Timing explains who gained from making the vulnerability irreversible. Once major houses refused renewal, marked down rail collateral, and withheld reassurance, Cooke's balance sheet stopped being a financial statement. It became a public execution schedule. The numbers reveal the blast radius. The New York Stock Exchange closed on September 20th and remained shut for 10 trading days. That meant roughly 240 hours of suspended public price discovery, an extraordinary interruption in a market culture built on visible quotation. The closure froze the public screen while private arithmetic continued. Debt kept moving in the dark. During those 240 hours, banks still knew who owed money. Trustees still knew which securities had been pledged. Lawyers still drafted assignments. Creditors still decided whose collateral would be accepted and whose paper would be treated as contaminated. The public market went dark. Private settlement proceeded. The broader economy confirms the scale. 89 of the country's 364 railroads collapsed into bankruptcy. 18,000 businesses failed within 2 years. By 1876, unemployment reached 14%. Those figures do more than decorate the narrative. They prove that the Cooke failure became a transmission system. A single firm closed its doors. A national balance sheet began to tear. The confession's accusation sits inside that transmission. It alleges that established banking houses accelerated the fall where acceleration benefited them. They refused selected extensions, forced selected sales, and preserved selected reserves. The method required no theatrical meeting. It required synchronized prudence. Synchronized prudence is difficult to prosecute. Each participant can describe his action as caution. One banker calls a loan because rail paper looks impaired. Another refuses a renewal because liquidity has tightened. A trustee delays acceptance because valuation remains uncertain. A newspaper prints restraint as wisdom. Each act looks defensive in isolation. Together, the acts remove oxygen from the same room. Cooke's Northern Pacific exposure gave the syndicate a public explanation. The exchange closure gave it darkness. The panic gave it cover. The victims supplied collateral at distressed values. By the time trading resumed, the story had already been simplified for public consumption. Overbuilding, speculation, weak rail securities, failed confidence. That account is accurate at the surface. It is incomplete at the mechanism. A market panic destroys broadly when liquidity disappears everywhere at once. A controlled purge destroys selectively when certain parties receive warning, extensions, and safe channels before the public shock lands. The 1894 confession claims 1873 belonged to the second category. It describes a crash that behaved like an audit, with Old Capital acting as examiner, creditor, purchaser, and historian. Jay Cooke became the visible corpse. The cartel kept the instruments. That is the omission. Cooke's weakness was real. Northern Pacific's structure was fragile. The official story treats liquidity as weather. The intercepted wire theory treats liquidity as a weapon. In September 1873, the weapon required no gunpowder. It required 10 days, closed doors, and men who received the signal first. The 10-day closure of the New York Stock Exchange remains one of the cleanest silences in American financial history. Public trading stopped. Private sorting continued. A locked exchange created the appearance of pause, yet debt kept accruing, collateral kept weakening, and social judgment kept moving through rooms where no public quotation could interrupt it. Inside drawing rooms, bank parlors, legal offices, and trustee chambers, Manhattan continued to price the men who could no longer price themselves in public. The closure removed the crowd from valuation. That was its structural value. When an exchange is open, even panic has witnesses. Prices print. Bids fail visibly. Buyers appear or disappear in a recordable sequence. When the doors close, valuation moves into correspondence, private meetings, forced settlements, and memoranda written for men who already know the outcome. Silence makes extraction cleaner. During the first days, the protected houses measured exposure. They reviewed who owed them money, who held railroad paper, who had pledged securities against social ambition, and who could be forced without damaging a protected name. The task was framed as market stabilization. The operational purpose was to decide which ruins could be harvested safely. Every creditor became an anatomist. They opened balance sheets. They separated cash from promises. They separated land from rumor. They separated wives' settlements from husbands' margin debt. They separated family trusts from speculative accounts. They separated men with old allies from men with recent success. The ledgers adjusted without sound. By the fourth day, the structure of survival had become visible to those inside the rooms. Some loans were renewed without announcement. Some collateral was accepted at generous valuations. Some signatures retained power. Other signatures stopped working. A name that opened doors in August became a warning mark in September. This was how erasure worked. A family disappeared when invitations slowed. Bankers requested additional security. Trustees declined appointment. Marriage negotiations cooled. Newspapers stopped printing movements. And club committees postponed votes without explanation. Financial death became social refrigeration. The body remained visible. The temperature changed. The confession claimed that the old money syndicate used the closure to clean the table. That phrase appeared twice in the deposition. It meant converting disorder into hierarchy before trading resumed. Bad paper had to be assigned. Salvageable assets had to be marked. Dangerous claims had to be buried inside reorganization structures. Protected names had to emerge with usable reputations. The hands were washed in procedure. Lawyers drafted instruments with dull titles. Assignment. Extension. Substitution. Receivership. Settlement. These words sounded administrative because finance had learned to hide force inside paperwork. A seizure looked crude. A trustee transfer looked respectable. A foreclosure looked unfortunate. A private consolidation looked wise. The same act changed costume. Inside the drawing rooms, women carried information more efficiently than many newspapers. A mother knew which engagement had become impossible before a banker admitted insolvency. A hostess knew which family must be seated farther from the center of the table. A widow knew which trustee had stopped returning calls. Social Manhattan priced disgrace in advance. The exchange reopened after 10 days, yet it reopened into a different city. Prices could print again. The sorting had already happened. Men returned to the floor with adjusted positions, reassigned expectations, and private knowledge of who had been sacrificed. The visible market resumed after the invisible market completed the first cut. As controlled stabilization. It allocates collapse. Old money survived 1873 because it held three forms of leverage at once. It held capital that could wait. It held social authority that could define failure. It held information channels that could move faster than printed truth. New money held assets, ambition, and debt. In a liquidity crisis, that combination became a target. Debt made them visible. Visibility made them selectable. The confession's final technical claim about the closure concerned ledger substitution. It alleged that certain message logs from the critical week were removed from routine retention and replaced with billing summaries. The summaries preserved charges while erasing content pathways. In bureaucratic terms, the revenue record survived, while the operational record disappeared. That is editing. A destroyed archive leaves a hole. A substituted archive leaves a surface. Researchers find paper, dates, totals, and administrative continuity. They miss the missing nerve because the surface looks complete. The clerk understood that distinction. He claimed the right record survived. The victims of 1873 included workers, merchants, railroad laborers, clerks, and small investors who had no private wire beneath them. The confession focused on families closer to power. That focus made their erasure more useful. A laborer ruined by depression proved little to old Manhattan. A rising family expelled from financial society proved everything. It showed that ascent remained conditional. It showed that wealth without institutional permission could be reversed. It showed that the city still had owners beneath the market's democratic costume. The deposition named several houses through partial references. The Bristow account appeared beside warehouse receipts and railroad margin debt. The Moreland note appeared near a Fifth Avenue leasehold and two daughters entering winter society. The Vale estate appeared heavily pledged against Western rail paper. House K appeared as rich in appearances, thin in cash, and useful as an example. Some names were masks. Some masks were names. The destruction was physical before it became archival. Furniture was inventoried. Horses were sold. Paintings moved through private dealers. Silver left dining rooms in crates. Servants were dismissed with wages delayed. Townhouse curtains stayed drawn past noon, which in that society meant the house had stopped performing confidence. Then the documents cleaned the scene. Family trees later preserved marriages, births, deaths, and property transitions. They rarely preserved the mechanism of exclusion. A genealogy can show that a daughter married late. It rarely explains that 3 engagements collapsed after her father's credit failed during a manufactured squeeze. A probate file can show asset transfer. It rarely shows the whisper that made the transfer terminal. Archives sanitize through structure. They record events. They omit pressure. The confession claimed one family patriarch attempted to confront a banking agent 2 days before the exchange reopened. He brought letters, collateral schedules, and a memorandum proving that a loan renewal had been verbally promised before the crash. He left without extension. Within 6 months, his name disappeared from 2 charity boards. Within 2 years, his sons worked under other men's signatures. That is how Manhattan killed quietly. It needed dependency. Other victims disappeared through absorption. A widow remarried into a safer name. A son changed firms. A daughter entered a family that required silence as dowry. A property passed through trustees until its origin became difficult to trace. Ruin did not always mean burial. Sometimes ruin meant incorporation under a cleaner label. The old families mastered this method. they could destroy and adopt. By the 1890s, the public memory of the panic had hardened into financial morality. Cooke had overreached. Railroads had been speculative. The market had corrected. The nation had suffered and recovered. That lesson was comfortable because it blamed excess while sparing management. It punished ambition while leaving inherited leverage untouched. The dead clerk's packet challenged that comfort. It said the panic had an operator. It said the operator wore no single face. The 1873 crash is usually taught as a financial event. It should be taught as an information event. The men who survived owned earlier signals, deeper credit, softer deadlines, and institutions willing to translate self-preservation into public stability. That is leverage in its pure form. It moves first, then lets everyone else call the result natural. In 1873, the signal traveled through copper. Today, it travels through fiber, matching engines, private terminals, settlement layers, risk models, and encrypted channels no ordinary citizen can audit. The machinery changed. The structure endured. Markets still punish those who receive reality last. Institutions still call that punishment discipline. History is filed by survivors, indexed by clerks, priced by institutions, and cleaned by families with enough capital to outlast accusation. The last telegraph operator did not expose a secret because justice had finally arrived. He exposed a mechanism because death had removed his employer. The wire is gone. The logic remains. Every age has an exchange floor. Every age has a private channel beneath it. Every age tells the public that collapse is random after the protected accounts have already moved. Inspect the contracts beneath history. Subscribe not as applause, but as access.